Welcome to the channel. I'm the Swedish dividend investor. So, as you have probably seen by the title, we are going to take a look into General Mills, ticker GIS. I've had them on my watch list for quite some time, and they have taken a beating since their high in September last year. Before we move on to GIS, I just want to thank you guys for the support. It feels like yesterday we hit 250 subscribers, and now we are over 370. Absolutely mind-blowing. So, thank you. Your support keeps me motivated to keep making these videos. Alright, as always, we will be using seekingalpha.com. Not sponsored. Yet. I've compressed the description of the company, but if you want a more detailed overview, just pause the video. General Mills is a global food company with four main segments: North America Retail, International, Pet, and North America Food Service. They make and sell a wide range of products, from cereals, yogurt, baking mixes, frozen meals, and snacks to pet food, under well-known brands like Cheerios, Häagen-Dazs, Pillsbury, Nature Valley, Blue Buffalo, and Old El Paso. Their products are sold through grocery stores, big box retailers, e-commerce, food service distributors, restaurants, convenience stores, and pet specialty shops. Founded in 1866, the company is headquartered in Minneapolis, Minnesota. And if we scroll up, we can see their one-year performance. Minus 27.8%, 5-year minus 21.8%, and 10-year minus 15.91%. The 10-year chart shows the food cycle, where we went from around $38 per share in December of 2018 all the way up to $90 in May of 2023. That's pretty good. And all along the way you collected a nice dividend. This is my kind of stock. Let's take a look at their summarized dividend stats. The yield is sitting at 4.87%, with the dividend forward being $2.44. Payout ratio of 57%. Years of growth, 5 years. And they pay quarterly. We can see their next dividend has the ex-date of 7th of October. So the distributions are February, May, August, and November. Let's take a closer look at their dividend stats. We can start with the history. We see 5 consecutive years of growth, 35 years of consecutive dividend payments. If we zoom out to the max chart, we can see they didn't slash their dividend. They just kept it steady between 2017 and 2020. Jumping over to the growth, we see the 3-year growth is 5.2%, 5-year at 4.22%, and 10-year is 3.55%. Nothing too crazy here. So, it's time for everyone's favorite segment, Spreadsheet Autism. Starting off with the charts, we can see the free cash flow goes up and down, but stable dividends and not so high capex. Revenue and earnings, they peak and they go down, but nothing massively. On the balance sheet, we can see their cash is trending down and the debt is rising, something we might need to keep in mind. Jumping over to the numbers. If you want a closer look, you can just pause the video here. Revenue and earnings, like we said, peaking and going down. We do see they are buying back their shares, from 619 millions in 2021 to 557 millions in 2025. And to the right I have some notes. This is just some quick stat about the dividends and cash flow. Speaking about cash flow, let's check it out. From 2.45 billion to 2.29 billion, with a high of 2.75 billion and a low of 2.09 billion. If we look at the dividend, we can see a lower number from 2021 and 2022. So, did they slash the dividend? No. Since they bought back their shares, they could pay out less in total amount, but more or the same per share. This is something to be wary about. Companies like Starbucks seem to have a great dividend growth, but most of it comes from share buybacks. So once the buyback stops, the dividend growth will be slower. We see their free cash flow payout is between 45 and 60%, give or take. Pretty conservative. Their 5-year average cash flow comes out to 2.42 billion. This is the number we will be using in the valuation. Their price to free cash flow is 11.16. That's a cash flow yield of 8.9%. Scrolling up a bit, we have the overview of some criteria I'm looking for. They don't have to be all yeses, but we can get a great overview. Dividend over 2.5%, yes. Low PE, negative free cash flow growth, and the list goes on. The only warning signs here would be the debt and the debt coverage. They can't cover the debt with 5 years worth of cash flow, and that's without paying dividends during that time. Anyway, let's move on with the valuation. It's kind of a hard nut to crack, since we don't know when the food cycle turns. We're going to be using a discount rate of 10% for all cases. This is our required return. For normal case, I've gone with 0 growth for the first 3 years, and 2% growth from there. Terminal multiple of 11. This is the priced free cash flow we saw before, meaning that's what we guess the multiple will be in 10 years, landing us at a present value of 27.12 billion in market cap. So around where we are today. So maybe that's what the market prices in. Best case, I've gone with 1% growth for the first 3 years and 3% from there. Terminal multiple of 13. We get a present value of 31.25 billions. For the worst case, I've gone with a negative 1% for years 1 to 3, 0 for years 4 to 6, and 1% for year 7 to 10. Terminal multiple of 9. We get a present value of 23.01 billion. So if you buy there, and the worst case plays out, you could still make a 10% annual return. As always, we use a mixed valuation using a probability factor. Here I gone with 70% for normal case and 15% for both best and worst case. Since I feel the best and worst case could be too exuberant, we didn't use any crazy numbers for the normal case in my opinion. We land at a fair price of 27.12 billion, and if we want to be real careful, 24.41 billion with a 10% margin of safety. Moving on to the dividend valuation. Discount rate of 10%. For the normal case, I've gone with 3.5% growth and a terminal multiple of 25, so a 4% yield at year 10. We land at a present value of $49.78. This is per share. Best case, 4.5% growth and a multiple of 30, so a yield of 3.33% at year 10. At the top of the food cycle, their yield was around 2.5%. We land at a present value of $60.54 per share. Worst case, 0 growth for 3 years and 1% until year 10. Multiple of 20, so a 5% yield at year 10. We get a present value of $35.29. Mixed valuation. Probability of 60-20-20. We land at a fair price of $49.03 per share, and with a 5% margin of safety, we would need to buy at $46.58. Hey, look at that, pretty much in line with today's price. Earnings valuation. My least favorite, since earnings can be manipulated more easily than cash flow or dividends. We are going to be using the 5-year average of earnings, so 2.49 billion. I'm going to be using the same growth and multiple as the cash flow valuation. Since the numbers look pretty similar, the PE is almost the same as the FCF ratio. We use a 10% discount rate here as well. Normal case, 0 growth for the first 3 years, 2% for the following. Multiple of 11. We get a present value of 27.83 billion. So, as in the cash flow valuation, this is about where we are today. Best case, 1% growth for the first 3 years, 3% going forward. Multiple of 13, and we get a present value of 32.08 billion. Worst case, same old, negative 1% for the first 3 years, 0 growth for years 4 to 6, and 1% growth from there. Terminal multiple of 9. We get a present value of 23.61 billion. Mixed valuation. 70, 15, 15 probability, we land at a fair price of 27.84 billion or 25.05 billion with a 10% margin of safety. So, if we go by the fair price, that's pretty much in line with today. Moving over to the tab called Macro. I've checked their annual report and here is something to be aware of. There has been significant consolidation in the grocery industry, resulting in customers with increased purchasing power. In addition, large retail customers may seek to use their position to improve their profitability through improved efficiency, lower pricing, increased reliance on their own brand name products, increased emphasis on generic and other economy brands, and increased promotional programs. If we are unable to use our scale, marketing expertise, product innovation, knowledge of consumer needs, and category leadership positions to respond to these demands, our profitability and volume growth could be negatively impacted. In addition, the loss of any large customer could adversely affect our sales and profits. In fiscal 2025, Walmart accounted for 22% of our consolidated net sales and 31% of net sales of our North America retail segment. Tariffs and commodity prices could impact revenue and earnings. If you want to read more about the risks and headwinds, I suggest downloading their annual report and go to item 1A, Risk Factors. With that out of the way, let's head on over to the main page and see the final valuation. At the bottom right, we can see their payout ratio, below 60%, which is pretty good. Under the intrinsic value, we can see the only under or fair valuations are the free cash flow and earnings. Under 1 is overvalued and over 1 is undervalued. The dividend valuation is sitting at 0.98 and 0.93 with a margin of safety. So if you would want more of a margin of safety, you could wait and see if they drop down a bit. But we are very close here. Mixed valuation. This is all the valuations adjusted for share price. We get a fair price of $49.23 and $44.76 with a 10% margin of safety. Conclusion. What can I say? I love food stocks and I love cyclical companies. The dividend yield is getting so close to 5% and a lot of money can be made on the food cycle, as we saw before. I would say a tiny drop, maybe 3 to 4%, and this is a buy for me. I'm seriously considering making this a part of my portfolio if I can get it cheap. So I'm going to watch it carefully going forward. But how about you? What do you think about General Mills going forward? Is it too risky? Let me know in the comments. I hope you enjoyed this breakdown of General Mills. If you did, make sure to show me some love by hitting the like button. And if you want to support my work, subscribe and share the video with a friend. But that's it for this one. I'm the Swedish Dividend Investor and I will see you in the next one. Stay smart, stay patient and keep stacking those dividends. Ha det gött!